Well, welcome back. This is the second of a multi-part series. 10 to 12 of these videos will be what we're going to do. We just finished the first one recently, and that was dedicated to the topic of equities, long-term returns of equities or stocks, however you want to think about it, versus bonds. And what we learned in that particular presentation is that bonds are great for the short term and they're lousy for the long term. And showed you lots of tables, short-term tables, intermediate term tables, long-term tables. But the bottom line is for growth, at least for passively managed portfolios that we might have in a 401k or a Roth IRA or a regular IRA, that these equity asset classes. Oh, and we also noted that there were different asset classes. There were different bonds, short, intermediate, long term, different kinds of equities, big, small, value, growth. So we have potentially a lot of slicing and dicing to do. And in this presentation, we start our slicing and dicing and show you the implications of combining some of these asset classes. As a matter of fact, very specifically, the asset classes that are recommended by the academic community as qualifying, in essence, to be part of a passively managed, long-term, do-it-yourself, buy and hold kind of a portfolio. But before we go to that, this new presentation, I want to just take one more quick look at what we talked about last time, because I do want to prepare you for something that has happened over the last 96 years. And what we have here is the results of the S&P 500, the large cap blend in red, large cap value in, I guess, tan, with U.S. small cap blend in green, and the small cap value in blue. And what we can then look at is over different time periods, starting back in 1928, and then looking even at the last 5 years. But if we look at the last 5 years, the S&P 500, clear winner, clear winner. If we look at the last 10 years, S&P 500, clear winner. Now notice that in both of those cases, small cap value came in second. So that is something you're going to notice here that is, I think, is of importance. And then we have over 15 years, it's kind of a tie for first place, slight advantage to small cap value. But S&P 500 right up there doing well, and the small cap blend and the large cap value not performing as well. And then when by the time we get out to 20 years, in this particular 20-year period ending in 2023, you'll see that they all produced about the same except for large cap value. But by the time we got it out at 30 or 40 or 50, 60, 70, or the entire 96-year period, what you'll see is small cap value becomes number one. The S&P 500 becomes, they're in last place. Now, it's important to understand that that's not because it's a bad investment. It's because it's a very, very good investment in terms of risk compared to these other asset classes. So when you have the higher quality investment, you do expect lower quality returns. If we took all of this money out of here and we put it into CDs, we'd have a guarantee, but the return would be very low, very high quality, but very little return. And it's the same. The S&P 500 is the star in terms of quality. The small cap value is the star in terms of the premium for the risk taken. And by the way, the academics will tell you there is no magic here. The reason that US small cap value did better over the long term is because it was more risky. That's it. It's a premium for the amount of risk. And of course, as we showed last time, and we're going to get into this some more today, when you start mixing and matching these and creating portfolios of all of these different potential investment asset classes, some real magic happens. And it's the same magic that happens when you put 500 stocks together versus one. Probability of gain actually goes up and the risk goes down. Okay, let's go on now and let's dig into what we have to talk about today. I have made this presentation for over 25 years. What has changed over that period of time is the only thing that changed is some years ago, I don't even recall, but many years ago, we added REITs to the portfolio. So we'll talk about that. But here is the bottom line, that the point, the thing I want to teach you that hopefully you will always remember. When we look here at the S&P 500 in what we call Portfolio 1, from 1970 to 2023, 54 years, what we know is that had you put $100,000 into the S&P 500 and just left it there, don't add any money, don't take any money out. Now, what's important here is that when you don't add any money and you don't take any money out, it doesn't matter the sequence of returns, whether the worst years are in the beginning or in the end or in the middle, or the best years are any place in that sequence. The end return will be the same. When we start dollar cost averaging in or taking money out, things change, but not based on what we call a lump sum investment. So what do we know? We know that over that period of time, the S&P 500 compounded at 10.7%. Not so different from what it compounded over the last 96 years. We can see the standard deviation of 17.2, a measure of volatility. And what that implies, or we want to look at, the standard deviation, why we look at it is because if those numbers get higher, it implies higher volatility. If it gets lower, it implies lower volatility. And we always want to be sensitive to that unit of return per unit of risk. It's one thing to get a higher return, but if you do that by taking an abnormal amount of risk, that might not be the smart thing to do. Now, we are going to make a change in this portfolio. We call this the ultimate buy and hold strategy. It is not the ultimate buy and hold strategy for return. From my viewpoint, it is the ultimate buy and hold strategy to give you some sense of learning. It is the best teaching tool I have ever had in showing people the implications of further diversification from the S&P 500. That's what we're focusing on here. Why the S&P 500? Because the S&P 500 or the total market index, they have virtually the same return for the last 96 years, but what they are the really big companies that you could in fact end up with in your portfolio. So, and why the S&P 500 as the base? Because it represents about 85% of all of the public corporations in the US. It is what most people have in their portfolio, either the S&P 500 or the total market index. And so what we want to do is we want to add some more risky, slightly more volatile asset classes, and some more volatile than others. And I want people to see, to learn how these very small changes in return and in the addition of more companies, little changes can make such a huge difference on what you have to spend in retirement, what you have to leave to others. And while we're talking about 54 years, well, I don't have 54, and people who retire at 65 don't have 54. But I can tell you, there are a lot of people who are retiring at 40 and 45, and they do have 54. But it really is just to understand how this concept of mixing and matching asset classes works. So, what we're going to do, we're not going to try to maximize the return. We're going to build a portfolio, adding pieces at a time. And when we're done, we're going to go from having everything in the S&P 500 to 10% each of a whole bunch of different equity asset classes that don't go necessarily up and down together. Now, let's just look at a small step here. Baby step number two, add large cap value to the portfolio. Remember when we talked about last time? Well, if you weren't there, let me tell you, large cap blend has both growth and value. Growth are the popular companies, value the less popular companies. People don't pay as much for the earnings up the PE ratio for value as they do for growth. And for good reasons, because the growth companies are the magic companies. Oftentimes that magic doesn't work out over the long term, but when it is magic, those companies can sell for very high prices. Value, not so high. Notice taking 10% of the portfolio and applying it to large cap value. Notice it goes from 10.7 to 10.8. Now, I'm going to tell you these are rounded. So it could be a little more than 1/10 of 1%, but the point is, I just want you to see that number one, the volatility did not go up. You added a more risky asset class, and the volatility didn't go up because they don't always, these two asset classes don't go up and down together. Plus, we're adding a very small amount of large cap value, but look what it did to the $100,000 investment. It took it from 23.9 million to over 25, almost 26 million. It was a $2 million increase in return for you, for your heirs, on that $100,000 investment. And to the extent that 100,000 is just impossible for you to think in terms of, then you can think of it as 1,000 or 10,000. It doesn't matter. They're easy to divide things by 10 if you want to be 10,000. You can divide it by 100 if you want to think in terms of 1,000. But a $2 million addition on a $100,000 investment and about a 1/10 of 1% extra return. Now, if what you're thinking, hey, it looks like it's worthwhile to try to find an extra 1/10 of 1%. Well, it turns out if you take the next step in portfolio 3, where we add 10% in small cap blend, you increase that return by about 2/10 of 1%. And now, oh, by the way, in the standard deviation, the volatility is still about the same as the original standard deviation of the S&P 500. So whatever you got, theoretically, you did not take any significant risk. So, well, on the long-term basis, for sure. Maybe over a day or two or a week or a month, yes, it will be different. But here's what we see. By going from 10.8 to 11, we go from 26 million to 27.7 million almost. And you've added almost $3.8 million from your original 23,900,000 approximately. And you didn't do anything that's fancy. You did this by owning the index. You, in essence, owned all large cap value stocks. Now, it isn't exactly all, but it is built basically on the idea of owning all or most of the companies in a particular asset class. Then we move on to small cap value. Now we know that small cap value is going to make it do better because we know that small cap value has been the gold ring, if you want to wish, of these asset classes. And in fact, by adding 10% small cap value, and you're going to see that 10%, the impact of that 10% adding almost a half of 1% a year in a whole bunch of other tables. And it's really impressive what even just a little bit of small cap value can do for the portfolio. But in essence, by adding 10%, it increased the compound rate of return by 0.4%. And now that number is over 33 million. And now you have added over 9 million to the original 23,900,000. And the final US asset class we add is REITs, real estate investment trusts. Now, they don't do much to increase return historically, and the reason that the academics will add them here in this portfolio, recommend them, is they do have historically a return that is very similar to the S&P 500, but what they bring is an asset class that doesn't go up and down together. So by adding that 10%, you have now brought the standard deviation down below what we started, now 16.9 versus 17.2, and increase the return still around 11.4. Well, when you actually compute what the exact addition was, you ended up with about not even $400,000 more money. So it did not make a huge difference in the return, but it did bring that volatility down a tad. Now we're going to do something so that I don't bore you with each of these little tiny pieces. I'm going to come in and all at one time, I'm going to add another 40%. I'm going to spread it among large cap blend, like the S&P 500, large cap value, like the large cap value in the US, and the same with small cap blend and small cap value, except internationally. Now, we don't expect this to be a big home run. Sometimes it adds value and sometimes it doesn't. But over this period of time, by taking out of the S&P 500, remember, we're taking out of large cap blend every time we do this, and we're putting 10% in international large cap blend and international large cap value and international small cap blend and international small cap value. So what you're doing, you're adding more of those asset classes that helped in the US, except now they're coming from the international markets, and they do help. It turns out by adding those 10% increases, you added about 0.1% each. And you might think, well, doesn't sound like a home run, but I can tell you by the time you're compounding on as much money as you have now accumulated, you have at the end of this period of time 42 million. You have now added, in fact, you've almost doubled the advantage you had before this particular edition. You're now up to over $18 million. You haven't quite matched all the money that was made as the S&P 500 itself. Remember, that was 23.9. Now we're up to 42 million, and we still have one more thing to add. And it is not a low volatility asset class. It's a high volatility asset class. And it can be the very best or it can be the very worst of these asset classes for many years at a time. But look at here what happens when you add emerging markets. You go from 42 million to 40, almost 49 million. You've added now 24, almost $25 million, which is more than was made in total just with the S&P 500. Now, here's what the academics who tell us these asset classes make sense. Here's what they also say. I mean, they have their weasel language too. You know, like past results are no indication of future results, just to make sure that people don't know you, that they know you can't buy the past. What they will say about the future is that these other asset classes will not create the premium all the time. They have never created the premium all the time. In fact, small cap value has for many long periods of time underproduced the S&P 500 for 15 to 20-year periods. That's not unusual. It turns out to be the norm. So this is all about long-term investing. But they do believe that these asset classes will create a premium over the less risky S&P 500. That's what they believe. But they won't tell you by how much. And so we have to wait and see. And as we noted before, there are periods of time that the S&P 500 is going to be king of the hill. Or queen, whichever it might be. They're going to be the best. And not just for a couple of years, but sometimes many years. So there's other information here on these combinations. We have 50% in US and 50% in international. That's important. That is more international than most of you are going to be comfortable with. I know that, having been around the business as an advisor for 30 years and another 30 years around the industry, but not as a personal advisor. But what I do know is that 50-50 US international is not comfortable for a lot of folks, particularly when the US is doing better. And sure, we always wish we had more in the good stuff when it's cooking. So I'm going to show you some different returns based on 70% US and 30% international in just a second, but I want to address one more lesson here that I find very interesting. Remember, I'm trying to help you be a do-it-yourselfer, a better do-it-yourselfer than you might be without this information. That's why we do this. And what I know is we either have to make a decision. Do we rebalance the portfolio? And if we do rebalance the portfolio, and the reason we might rebalance the portfolio is because when a particular group of stocks are off the charts, you might want to take money from the rich and give to the poor, because historically, what does tend to happen over time is you have these periods of underperformance and outperformance by these different asset classes. And in rebalancing, you pull the portfolio back to your original concept of what is the ideal asset allocation. Now, this becomes way more important when you've got fixed income as part of the portfolio, and we'll be talking about that in a couple lessons from now. But I can tell you right here that this particular worldwide equity portfolio, ultimate buy and hold from 1970 through 2023, was rebalanced on an annual basis. So if certain asset classes had done better in the previous year, then you take some of that money and you put it into the ones that did worse. So you go back to the same 10, 10, 10, 10, 10, 10, 10, 10, 10, whatever. But what if you did it monthly? Well, if you did it monthly, that sounds like it would be more conservative, because it means that every time one of those hot shots kind of took off a little bit, at the end of a month, you'd be pulling them back in and taking away some of those extra earnings they got. And they may go on doing better and better for months on end, but you keep pulling them back in by taking off the cream and giving it to the ones that have been underperforming. And there is a difference theoretically. And certainly you'll see it here. If you rebalanced monthly, notice the total end result is about $4.9 million. Standard deviation of 18.3, that was a 12.1% compound rate of return. If you had rebalanced on a monthly basis instead of an annual, you would have about 44 million. You would have left a bunch of money on the table. But it's understandable why that happened. It's because you have asset classes that you kept the reins tight. Then you let them go for a while, but then pull them back in again. And there's nothing wrong with that, because what that led to was a lower volatility, lower return, lower volatility. There are lots of ways you can get a lower return. You can get a lower return by buying mutual funds with higher expenses. You can get a lower return by buying mutual funds that are actively managed. You can get a lower rate of return if you pay higher taxes on your profits. You can get a lower rate of return if you try to market time and try to dash in and out of the market based on how you feel about the future. And you can get a lower rate of return if you rebalance more often. Now, that doesn't always work out that way, but it does most of the time when you look at long periods of time. So you can look at each level, you'll be able to see that there were some differences, and it typically is about 1/10 of 1%. But at the end of the whole mixing of all of the 10 asset classes, it was about 0.2% less. So I'm hoping when you look at these tables, you're thinking, boy, if I could figure out a way to make another 0.1% and do that over a lifetime, that's a meaningful thing to do. And by the way, you are trying to be a do-it-yourselfer. You are not going to pay somebody 1% to manage your money. Think of that. Because you can look right here. Because the S&P 500 had a 10.7% compound rate of return. When you look over at the international, by the time you get to portfolio 6, notice that compound rate of return is about 1% higher. So in essence, by deciding to do this yourself, this is why we're trying to help you do it yourself, so you will have more money, and your children and your charities will have more money. You will have more peace of mind. But you got to learn, I think you should learn this information, and you're going to have a little bit more anxiety in your life than turning it over to somebody else. I understand that. But we're trying to show in this series the things you might want to be anxious about, and then understand why that anxiety may not be worth the energy. But you can see here, if you could find another 1.1% here from portfolio 1 to portfolio 6, it gave you almost twice as much money than you would have gotten with the S&P 500. It's a big deal. Now, I want to go here to the next way of looking at these. Now, I'm going to look quickly at this because we're going to, in the next class, the next segment, we're going to dig into these 9 portfolios. We're going to look at them in a way, or give you the opportunity to look, if you want to, at 1 year at a time. You're going to look at the good times and the bad times. You're going to look at some things that may not be of any interest to you, like their Sortino ratio or their standard deviation. Don't have to look at all those things, but you're going to see them if you want. They're just ways of measuring that relationship between risk and return. But here in table A2A, we're not talking now about owning 10 equity positions. We're talking about turning these 10 inside out and showing you the implications of mixing and matching them in different ways. And they're all legitimate. Some are riskier than others. Some make more money because they're riskier than others. I mean, we've got the S&P 500 here just as kind of a benchmark. But it's a legitimate thing to do. Just put your money in the S&P 500 or total market index and forget about it. Now, at some point, you need to add fixed income, probably, but it's very simple and it's very solid. But you're still going to have, and you're going to see that, by the way, in the next session. You're still going to have a lot of losing periods that are uncomfortable. And as a matter of fact, you may even question that whether there's all that much difference between all these portfolios when you see the downside. I found it fascinating. I saw things I did not expect to see. Then right next to the S&P 500, here again, and with this $100,000, what did it grow to? We just got done with that 50-50 strategy, was 49 million almost. But how would you have done if what you did was just put 25%? By the way, you can look right down here at the bottom of the page. Worldwide for fund, 25% S&P 500, 25% small cap value, 25% international large cap value, 25% international small cap blend. About the same, a little more volatile than the 10 fund strategy, but you ended up making 0.2% more. For fund is just 25% each. U.S. large cap blend, large cap value, small cap blend, small cap value, very simple portfolio. Now you're up to over about 49 million. Then we have an all value portfolio worldwide. You have some small, some large, some U.S., some international, some emerging markets. Standard deviation is higher, but not a lot, because instead of making 24 million, you're making almost 70 million. Then U.S. all value, some large, some small, worldwide all small cap value, all by itself. I think you're going to find it fun to compare the risk of getting the 13.7 versus the risk you had to take to get the 10.7. I think a lot of you young people might see it as something